G'day guys and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market and everything that's happening in real time. Now today guys, we've got big Tim Lawless back from CoreLogic. He's the head of research over there guys, and we're going to be dissecting the same way we did last RBA meeting about everything to do with the interest rates, what's happening with that at the moment, what are the forecasts right now, and heading into the end of this year and into next year as well. There's obviously been a lot of chatter lately around interest rates going up, going down, inflationary numbers, all the rest of it. We've got big Timmy Lawless on to dissect all of it. He's probably the most respected person in terms of an economist in the Australian housing market. So I'm really excited. On Tim Lawless, head of research over at CoreLogic, mate. Welcome back to the Scouting Australia podcast.
Thanks, Sam. Thanks for inviting me back in, mate. I think the last session must have gone okay.
It did, mate. It did. It definitely did. We had some really, really good reviews. Mate, I've got to say, I was even listening to it the morning after on my run, mate, and you had me in some stitches with a couple of things you were dropping there. So it was good, mate. You bring a bit of laughter to the topic around economic, drivers and whatnot around property and the interest rates, mate. So it was good. Really, really excited to have you back on as well.
Oh, good, and very timely as well, mate. We just saw the RBA announcing their hold decision like everybody expected, and it looks like that's going to be quite well accepted by the market. Hold is certainly good news.
Definitely, mate, definitely. Mate, that's what I'd love to discuss with you as well, because I think it's a funny thing, even around saying that, around like the hold that was expected, because there was a few bears out there saying, they're going to put it up because of different things happening with inflation and the Aussie dollar and whatnot as well. Do you want to dive through, I guess, dive straight into what the RBA sort of came out with, and kind of the outlook for that moving forward as well?
Yeah, I mean, this was always going to be a live RBA meeting, especially given the stubbornness of inflation, and that's what everybody was waiting for. We saw the June quarter inflation data come out last week, or the end of July. That was a real, I think, message that inflation's coming down. We saw core inflation come in at 0.8% over the June quarter. That was down from 1% in the March quarter. Headline inflation still holding up a little bit high. But, I mean, the core inflation is what matters for the RBA. And that's come down, still high. And I think that was the clear message from the RBA is, sure, core inflation's come down a little, but it's still uncomfortably high. We're not out of the woods just yet. So I think all eyes are going to be on those inflation numbers going forward. If we do see any turnarounds like we saw through the March quarter, a higher than expected inflation number, then who's to say we might even see the RBA once again going live. But at the moment, if you look at financial markets, they've actually brought their timing for a rate cut forward now. The day before, as of last Friday, financial markets were sort of thinking February. Before, like a week before that, it was more like May for the rate cut. Now it's November. In line with two of the big four banks as well, still have November penciled in. The other two have February penciled in. I wouldn't be surprised if, given the updated forecast from the RBA, we might even see the other two of the big four reining in their timing for rate cuts as well back to November. So, it looks pretty positive at the moment. And, I wouldn't be surprised if we do see the whole decision from the RBA, as well as lower inflation, flowing through to a boost in consumer sentiment, which is generally pretty important for housing markets as well.
So your opinion, and actually just to kind of, give the listeners a little bit of insight around that. Obviously, last time we caught up, there was the big economists, 39 economists all came out and they all said they were kind of calling between that November to February. And I think you and I were both sort of thinking the same thing around that February, I think from the last time we chatted. But then a few things sort of changed, and inflation being a big one of those, right? They kind of, it was dropping pretty, I think it did, came down 1.1%. I think it was up to the March one. And then it obviously started, it eased, it held stubbornly high, as you're saying there. What do you think are the real key indicators that are going to allow them to be able to cut it, right? Because if it stays around this sort of rate again and stays stubbornly at this point, all the way through to November, are you thinking that it's going to be coming back from that perspective? Is that what the kind of consensus is? Or do you think, regardless of that movement, they're still going to be looking to cut it in November?
Well, I think it's more than just inflation. So inflation's probably the most important indicator at the moment, particularly core inflation. I don't think, headline inflation is really important, but it's a lot more volatile. And what we're going to see over the coming quarters is headline inflation is going to come down to the target range. But that's in some ways just a mechanical lowering through.
Do you mind if sorry, Tim, I don't mean to cut you off there. Do you mind just explaining as well the difference between headline and core inflation as well for those who don't know?
Yeah, absolutely. It's a really important distinction. So headline inflation is just the raw numbers of inflation, right? And headline inflation, or the actual inflation numbers, they do tend to move around a little bit because there's some pretty lumpy things within the inflation numbers, like energy costs, fuel costs. Sometimes you might see the cost of fruit and veg, for example, get really volatile. Bananas, there was a period a decade ago where banana prices just rocketed higher, and it actually had an impact on inflation.
Did it really?
Yeah,
That's crazy.
So core inflation, or what the RBA prefers to look at, is the trimmed mean, which is another way of describing core inflation, strips out some of those volatile items. So it's a much more stable reading of inflation, or an underlying reading of inflation. And it's generally what the RBA would be making the monetary policy decisions on. But watch out for headline inflation, because that's going to be coming down, as I said, mechanically, simply due to energy rebates that are coming out. So energy costs are a pretty big part of inflation. So fuel bills, electricity, that type of thing. Nationally and at the state level, there's rebates that went live on July 1st. So that's going to bring headline inflation down. And the RBA is going to take notice of that. But I think most importantly, they'll be focusing on the core inflation numbers, because you can't really manipulate them through energy rebates or concessions, that type of thing.
Because that was the consensus, right? That the government in the budget coming out saying around those, the rebates, the idea of it was literally to pull inflation down, right? Like kind of directly impact it from that perspective.
Yeah, that's exactly right. Well, the political message would be easing cost of living pressures, but also it's a good look politically to get inflation down. But I'm just looking at the trim mean inflation forecasts from the RBA, because they just put out the statement of monetary policy as well. So they've got the trimmed mean coming down to 3.5% in December. That's actually a little bit higher than the previous forecast that was 3.4%. But then by mid-June, it should be down at 3.1% and then down below the target range. So the RBA has a target range of 2 to 3% inflation. It should be getting down below the top end of that target range by the end of 2025. So this is a pretty long journey we're on. And the RBA always talks about the last mile of inflation being getting inflation from 4% down to 3% down to sort of sub 3 is generally where the biggest challenge is.
Yeah. And it's understandable, right? Because when the big changes come in, and especially when the market's slow, even economically, to go from like the 8% where we were all the way down to the 4%, like that's a huge drop. That, like they're saying, to get into that target band, it's kind of the tricky game they've got to play, right? Because we still want to stay in economic growth, but not too much, right? And that's the balancing act of this whole thing.
Yeah, it's the Goldilocks moment, right? So you don't want it. You want it to be too hot. You don't want it to be too cold. And it's such again, the RBA kind of describes it as a narrow path to walk. And absolutely, at the moment, I think that path is even narrower than normal, given some of the just the sensitivities around cost pressures. The good news, I think, from a housing perspective, housing is the biggest component of inflation. So inflation, the items in the inflation basket are all weighted. Housing is the biggest weights, and the biggest weights within the housing basket are the cost to build a new home. That's definitely coming down pretty quickly. And rents would be the second biggest component. Then you've got utilities. So rents are starting to fade a little bit now. In fact, the Statement of Monetary Policy has a really good graph about market rents and CPI rents, and how the market rents tend to lead CPI rents. Market rents peaked about a year ago. So we're now starting to see that flow through to CPI as well, which is really good news.
When you say peaking, so you mean the peak rate of growth, right? So they're still potentially growing, but it's a peak rate. Same as the building, when you said coming down, it's the building rate of growth, or the actual price growth of those things are actually slowing down, right? Rather than stopping or coming backwards.
So true. Yeah, really good clarification, Sam. The peak rate of growth. So we're definitely seeing rent still rising kind of 7-8% per annum at the moment, which is rocketing, but it's down from like some markets like Sydney and Melbourne. We're seeing unit rents rising 15 to 17% a year ago. So
it's huge.
Yeah, a long-term rental growth, you typically expect it to be somewhere between sort of 2 to 4%. So at 7 or 8%, that's still pretty high, but it's definitely decelerating.
Definitely, man. No, I couldn't agree more. It's a funny thing, hey. Like I remember a few years ago looking and going, "What's going to drive the housing, the rental markets, right?" Because they had the price growth had been so strong for so long, and then obviously the rents have now finally played a bit of catch up. I know a lot of stuff I had in Brisbane, Perth, even Adelaide, kind of doing 20-25%. Some of my properties over a 12-month window, like releases and jumping them up that much. So it's still good. Obviously, we're having that growth rate, but almost like that sustainable growth period is almost a lot better from a fundamental sort of long term perspective rather than that really rapid, almost unsustainable level as well, which directly affects inflation as well, right? So
Yeah, absolutely. I couldn't agree more. Having a more stable housing outcome is much better, I think, for any investor. Sure, the market's always going to be cyclical, but when you go through phases of extreme growth, there's generally a downside to that, right? And affordability challenges become more pressing. You have policymakers become a little bit more, edgy and try to deliver mechanisms to the marketplace to artificially slow things down. So, yeah, coming out of such a strong period of rental growth, we're already seeing a lot of rental reform is underway.
definitely.
A lot of noise coming out of different areas of the political realm as well about what to do about rents. But naturally, as rents become unaffordable, which they are in many areas, you generally start to see a restructuring. And we're starting to see that now. You're starting to see group households once again reforming. Average household size is rebuilding a little bit. Net overseas migration has been slowing for more than a year now. That's taking some heat out of rental demand as well. So, yeah, naturally things just tend to balance without the need for overt intervention. Unfortunately,
Yeah. Yeah, for sure. No, I agree with you, mate. That's cool. That's a really good breakdown. I appreciate that, mate. One of the other things I'd like to know, just your opinion on as well, is there's a lot of people, or like I kind of said when we kind of led into this as well, is there has been chatter around the potential of a rate rise. And obviously, you said you got the big four banks. Two of them are in November. Two of them are in February. A lot of other economists are kind of sitting within that realm as well. What do you think of these people kind of talking about the potential for a rate hike as well? Like, what is the actual likelihood of that happening?
Yeah, I'm hearing less of that now, to be fair. And a lot of that commentary was when inflation was still seen as quite high. We saw the
Yeah.
monthly inflation numbers coming through, which did surprise on the upside. The monthly inflation numbers are a partial reading on inflation, so they don't give you the full view. So I think when as the quarterly inflation numbers came out, which gives you the official read, it came in a bit lower than most were expecting. So I don't think you'll see as many economists predicting or forecasting another rate hike. There's always going to be some on the fringe, and generally the sort of
Trying to
rational.
grab some headlines, right?
You're looking at things like the risk of services inflation holding higher for longer, forcing the RBA's hand. They might be seeing things like you can see shipping costs are rising quite rapidly now as well, which have the potential to flow through to inflation. So there's generally a solid argument behind any sort of forecast. But mainstream view, I think now would be the next move is going to be down. The only uncertainty is the timing. But as we've seen over the last 6 months, these things change, right? And it's all dependent on the flow of data. So, watch the data. And something the RBA was really clear about today is their decisions are going to be based on the flow of the data coming through.
Yeah, for sure. And so, obviously, like the lead indicators of listeners, we're trying to stay in front of this thing and kind of forecast it themselves as much as possible. Other than like the inflationary numbers, is there anything else you would suggest to potentially keep your eye on and track for these guys to kind of keep yourselves finger on the pulse, so to speak,
Yep.
almost being ahead of the game?
Yeah, so the RBA has two mandates, inflation and labour markets, right? So they're aiming to keep labour markets around full employment. And we are expecting labour markets will gradually loosen back to what the RBA would describe as full employment. Currently, it's beyond that. So if you look at forecasts for unemployment, we'll probably see the unemployment rate moving from kind of 4 to 4.1% at the moment. That's likely to get up around 4.3% by the end of the year, probably level out about 4.4% around the middle of next year. Remember, the long run average for unemployment is 5.5%. That's over the past decade. So even at 4.4%, that's still pretty tight, but it's definitely not 3.7% where it's sort of bottomed out at. So watch for labour market trends. If we do see the labour market holding tighter than those forecasts, then that's absolutely a risk that interest rates could stay higher for longer, simply because the RBA would see tighter labour markets as then fueling higher wages growth, which then can flow through to consumption and more spending.
Very
The
true.
other things to watch for would be just economic outcomes. GDP is the key measure of economic activity. That's been really soft, and it's something the RBA has called out as well. Is that economic activity is well below trend, but that is forecast to start picking up as well, especially if we do start to see the residential construction sector capacity constraints freeing up maybe a year or so from now. That should really flow through to picking up economic activity as well. So they're probably the three main things: inflation, labour markets, and economic activity. Peripheral to that, you'll be looking at other things like consumer sentiment and consumption. So consumption is simply how much are households spending. They'll be looking at the difference between headline inflation and core inflation, and also looking at global outcomes as well. Global uncertainty is always going to be a wild card, but that seems to be quite elevated at the moment.
Yeah, mate, it's a great point there, even in terms of like how everything's almost like so closely linked, right? Like I wasn't even thinking a little bit around like the labour markets. When the labour market stays super tight, you're getting that wages growth obviously directly affects inflation numbers as well, right? So it's funny how all these things, they're so closely linked, right? Like so many people just look at the inflation or just at the interest rates or whatever, but there's so many things sort of tied together with it as well.
Yeah, and then maybe even indirectly, if we do see interest rates coming down eventually, I think the last thing the RBA and the broader Council of Financial Regulators would want to see is a significant rebound in housing prices, because that fuels a wealth effect and then consumption and pushes inflation higher again. So, I've got a sneaky suspicion that when we do actually see interest rates coming down, whenever it is, we might not see the same sort of really positive flow through to housing market conditions as what you might expect during a normal cycle, partly because affordability is already quite stretched. And maybe the cities that will respond better to lower interest rates will be those that don't really have as much of an affordability barrier. Melbourne's a pretty good example of that now. It's the one major city where affordability is actually improving and where yields are rising.
Mm. It's an interesting component, isn't it, mate? It's one thing that I've been banging on about for a long time, like the affordability in the market that we're in right now. They're the markets that obviously have the propensity to have a lot more growth kind of come through, whereas these markets that are already proven performers and they've had a huge amount of growth, they're sitting extremely unaffordable. Even if interest rates come back a little bit, it still doesn't give them that much room to still push. Whereas those lower, like you're kind of saying, they're lower price markets. Melbourne, for example, is a very interesting one. Looking at those numbers around the affordability factor, still very strong there. There's always so many factors to take into it, but affordability is a pretty key one in terms of how much room a market has to grow. So, yeah, interesting. You put some good weight behind that as well.
Yeah, I think there could be some counter-cyclical investing happening in Melbourne. It seems to be a little bit on the nose at the moment for investment activity, but like I said, it's getting more affordable. We've already seen Brisbane prices exceed Melbourne's prices. It looks like Perth and Adelaide are on their way to pass Melbourne as well in terms of the median dwelling value, which is pretty unique, especially for Adelaide to be higher than Melbourne. We've never seen that in the past.
It's about a quarter of the population, right, or a third. It's tiny compared to Melbourne. So it's wild for that city to actually be higher than it from median value wise.
Yeah. Adelaide's actually interesting. It's one of the few capital cities that's accelerated over the past 3 months in value growth into July, but it's also nearly at the top of the league's tables for unaffordability when you adjust for local incomes. So dwelling value to income measures, it's second after Sydney. It's got the highest portion of household income being dedicated to rent. The second highest portion of income dedicated to paying on mortgage as well. So it's probably the one really well-performing market at the moment that's looking pretty precarious and probably overshooting the mark more so than, say, even a Perth, where we're still seeing Perth's kind of lower to middle end of the affordability range.
Yeah, I'm with you. The really interesting thing, we did a round table a couple of weeks ago. We did it with the Australian Property Scout team in the podcast, and we were dissecting a lot of things, and that conversation actually came up. But the really interesting thing was that the stock depletion, which would fall in line with what you said around the Adelaide's resurgence in the last 3 months, it actually has the tightest stock, and it had fallen to the lowest point we probably pulled the article from you, mate. This probably isn't news to you, but like how much of a stock depletion that they've actually had as well. So it's like you say, they're in that precarious position where they're right at the peak of unaffordability. That the housing market is still so tight right now that it's still, it's obviously still holding quite firm, right?
Yeah, listing numbers in Adelaide are like 35% below average for this time of the year.
Crazy.
It's Brisbane, you can definitely see stock levels are picking up a little bit now. They're still a little bit more than 30% below average also, but yeah, they're starting to lift as vendors become a little bit more active as well. But some of the weaker markets like Melbourne, we're seeing stock levels now about 15% above average. Hobart has got a lot of stock available as well, definitely a buyer's market, so is Melbourne. Whereas buying into these really tight, hot markets like Perth, Adelaide, and Brisbane, there's not a lot of stock to choose from. You've got a real amount of urgency behind your decision making. Like homes in Perth are selling in 10 days now on average, whereas the median. There's just simply no time to deliberate and negotiate. Otherwise, someone else just comes and buys the home out from under you.
That's it, mate. It's actually wild to see as well, because like the 10 days is the median, right, in terms of what's listed. But knowing from being on the ground, mate, you got 24 hours max, and that's off market. You got 24 hours. Like when they're on market, they might give it a week for a feeding frenzy to let 50 people bid against each other, mate. It's wild over there. And Brisbane's not much better. Adelaide, mate, sitting in the same boat. So it's a crazy market to be in, mate. I've seen some hot markets, and it's definitely right up there with the best of what I've seen before. So it wouldn't be a nice time to be trying to buy on market, that's for sure.
Literally the Wild West.
That's it, mate. That's it. I couldn't agree more, mate. One other kind of final thing I wanted to wrap up on was what's your opinions around some of these banks starting to bring out, like big four banks as well, starting to bring out longer term fixed rate mortgages lower than the variables? I haven't seen that for a while, and they're starting to come in at reasonably healthy rates. Obviously not the 2s and 3s we saw a few years ago, but starting to slide into the 5% for the longer term sort of fixed rate mortgages. What are your thoughts on that?
Yeah, it's a good sign the rate hiking cycle's peaked, isn't it? It's
Agreed.
Banks are pretty good. The treasury teams in the banks are pretty good at pricing their loan products.
The big bucks.
Yeah, they look at things like the long-term bond rates. They look at what's happening with interest rates in the US, in Canada, in our Western counterparts. And to be honest, Australia is generally not the first to move interest rates. We've already seen a few of our Western counterparts coming down. UK is probably on the cusp as well. So, yeah, it doesn't surprise me we're starting to see fixed rates coming down a little bit. It looks like we're still seeing most borrowers opting for variable like they normally do in Australia. But yeah, there was definitely some smart money that fixed at very low fixed rates back in the pandemic. We're still a long way, I think, from fixed rates bottoming out, and I wouldn't be surprised if most still lock into variable. But I think simply the fact that fixed rates are coming down is a really good sign that we're beyond rate hikes now.
Definitely, mate. I'm with you. It was funny. Something I was told years and years ago is it was from an investor that had been investing for like 20, 30 years or something. He goes, mate, I don't try and bet against the banks when they're economists who are getting paid $1 million a year. You're betting against them, right? Most of the time, fixing an interest rate that you're gonna end up financially in front of where they are. So if they're starting to bring them down, it's normally a pretty good indicator that they're seeing, especially that longer term average, it's going to be coming down below that as well. So it's positive signs. I believe that we're probably at the back end of it, right? Or it's beyond us, that rate hiking cycle in the end of it.
Yeah. And then the downside for interest rates will be a pretty gradual one. I think don't expect rates to come rocketing down lower. I think it's going to be a fairly cautionary trajectory for the cash rate.
Yeah, agreed. Mate, when we last caught up, you were calling, I always love to kind of just get people's perspective, opinions, almost like a bit of a bet. In terms of, I think you were calling February next year is when you think the first rate cut's going to come through. You still sticking to that? You still thinking that's pretty much on the money?
No, I'm probably November now.
Oh, okay, bring it forward.
I think I'm bringing forward my my forecast on the data flow. So yeah, and I wouldn't be surprised if we see some more forecasts being brought forward as well. Simply that, the financial markets are generally a little bit more bearish than economists, and first time I've seen financial markets nominating November for the first rate cut as well. So yeah, I think that goes to show that the stars are aligning finally, and we might be on the cusp of a rate cut this calendar year. So Yeah, my money's now on November.
There we go, bringing it forward. Mate, I love it. I love the bullish prediction, bringing it forward. I know my portfolio and all the investors listening to this will appreciate that if it does eventuate as well. So fingers crossed, mate. One final thing as well, predictions heading into the back end of the year, mate. We're in very early August. We've got 5 months of the year left to run. It's, we're kind of talking about those markets that were red hot before. I know you got your finger on the pulse. Yourself and Eliza work very closely, assessing all this stuff and picking, where you think and giving the market commentary. What's your opinion rounding out the year? Best sort of growth markets out there. Do you think anywhere's going to turn the nose that maybe isn't performing well and we'll turn it, or anywhere that's going to shoot the lights out? What are your thoughts to round out the year?
We're definitely seeing the cycle at a macro level losing steam. So the national rate of growth, the combined capital city rate of growth is losing steam. We're seeing values rising, but generally rising at a slower pace. Melbourne's now moving into a downturn. Over the last 3 months, Melbourne was down nearly 1%. Hobart's consistently falling. Canberra and Darwin are looking pretty shaky as well. So, yeah, we're now seeing, nearly half of the capital cities are either flat to falling. But at the other end of the spectrum, you've still got markets like Perth, Adelaide, Brisbane, some regional areas in those 3 states as well, SA, WA and Queensland also seem to be quite strong. You wouldn't expect that rate of growth to be sustained, though. I think you'll probably find each of those markets does slow down in the trajectory of growth through the second half of the year, just as something that's more sustainable. You'll find naturally affordability pressures will start to bite. But I think you'll probably see through the second half of the year that same paradigm, Perth, Adelaide, Brisbane leading the growth trends, Melbourne probably leading the weakness, Sydney joining Melbourne, either flattening out or falling in value. But like I said, once interest rates come down, that might start to be a little bit more reinvigorating for markets like Melbourne that are becoming more affordable. I don't think lower interest rates are going to have a remarkable impact on some of the more expensive markets because those barriers to entry will still be there. Affordability challenges and borrowing capacity will improve a little bit, but not if values have sort of risen to offset that. So yeah, I think a little bit more of the same, but not quite as strong the headline growth rates we've seen over the past 6 months.
Yeah, perfect. So you pretty much, the markets that are still performing will continue, but maybe not at the same rate. And then because it's been a pretty crazy first 6 months for those 3 capitals you're talking about, and then the other capitals that are flatlining, stagnating, you're probably seeing that continuing at least for the rest of this year, and some regional markets in there picking up and performing from that perspective too.
Yeah, that's right. And remember, spring, we generally start to see inventory levels starting to pick up as well. Definitely. So for people out there looking to buy, there should be more stock around to choose from. And, markets like Melbourne or Hobart, absolutely buyers markets now. For a counter-cyclical investor, there's a lot of stock to choose from. You can drive a hard bargain. There might be some good positioning happening if you're in there for a medium to long-term investment.
Yeah, for sure. Perfect. Well, Tim, mate, as always, really, really appreciate your time. Is there anything you want to wrap up with, mate? Or are you happy to finish with that?
Mate, I think that's pretty good. Yeah, we covered a lot of ground.
That's a great market wrap up, mate. No, I really, really appreciate it, man. Jumping on, sharing all the knowledge on everything that's going on at the moment. So just want to say thank you once again, Tim, mate. It's been an absolute pleasure having you back on the Scouting Australia podcast.
Always a pleasure, Sam. Thanks for the invitation, mate.
Perfect. Thank you, Tim. Appreciate it, mate.
Cheers.